Hi guys, Boris Dorfman, your trusted multi-state mortgage lender, private lender. I had a question from somebody. What do I think about 40-year mortgage program for conventional loans? And what do I think about 20-year products? A lot of people ask me, because they see there is 40-year product. What are the pros and cons of a 40-year mortgage product, and what do I think about it? Personally, I'm a true believer in leverage. The longer you can have a mortgage on your property, the more you can use somebody else's money at low interest rate. And we're talking about conventional. There's no such a thing as a 40-year. There is such a thing as 40-year amortization for hard money, but you're not going to hold a mortgage for 40, 30, or even 10 years. So these are long-term products we're talking about. So what is 40-year amortization? That means you get $1 million mortgage today and you fully amortize it over 40 years. You make payments over 40 years and you get to zero. Same thing, 30-year product. That's the most conventional product out there. You get a 30-year mortgage and you amortize it over 30 years. You take it today in 2021 for $1 million. And in 2051, if you make the same payments, you're gonna pay it off, okay? So pros and cons. Number one, most people, 95% plus people out there, don't hold the mortgage for 40 or 30 or even 20 years, okay? It just doesn't, if you get a mortgage today for 20 years, that means 20 years from now, 2041, you're gonna have a zero mortgage. It doesn't happen for multiple reasons. One, you don't know what's gonna happen tomorrow, let alone 20 years. You may sell that property, okay? Two, the property may go up in value and you may cash out from it. You have $1 million mortgage today, 10 years from now, property is worth $3 million. You may want to cash out and take $1 million out, get a new $2 million mortgage. The interest rates may decline, okay? They may be lower than today, so you can roll into your new $1 million mortgage that you pay, you're at 3.5% today, into a new 2% interest rate. So for multitude of the reasons, people get married, they need a bigger place. They sell, they refinance. People get divorced, they divide up the assets, they sell. On average, latest statistics a few years ago, I checked, people hold the mortgage for 7 years. And I'm sure it's less now. There's no pride of ownership. People don't live in the same homes. And commercial mortgages, most of them are adjustable, okay? So, what's the difference for the most part between 30 and 40? It's the payment. Maybe interest rate. If there is a 40-year product out there that has the same interest rate as a 30 years, all it is, you're spreading out your initial payment over 40 years versus 30, and your payment will be less because your amortization period is longer, okay? So what is the benefit of a 40 over 30? You just pay less. And unless your idea is to pay off your mortgage as soon as possible, go with the 40 years. Okay, some people, they're getting near retirement, they want to pay off their property or properties, okay, and they want a lower amortization, 20 or even a 10-year mortgage, right? So figure you're 50 today, or 15, right? 15 is a very conventional product. You're 50 years old today, you're planning to retire at 65, you want to have a paid off home, get a 15-year product. The shorter the amortization term, obviously, you're paying off your home in 15, not 30 or 40 years, your payment is going to be higher. So look at your cash flow, look at your salary, look at what you can afford to pay. Because, you may want to have a 10-year mortgage. Doesn't mean, besides the interest, let's say $1 million mortgage, spread the principal over 10 years, that means $100,000 in principal has to be paid in a year. Yeah, under 30 years, it's 3,300. I mean, 100,000, 33,000 plus interest. okay, on top of it. So 100,000, that's almost 10 grand a month. With interest plus interest, it's going to be more. So also there's a big difference between primary residence and investment. You want to be as leveraged as possible on investment properties. As the property goes up in value and your mortgage gets paid off little by little, you want to be able to cash out as much as you can to buy multiple properties. The book says you want to have as little debt on your primary residence. It's a great idea if your income is not stable. You're going to retire. You may most likely you're going to be your earning potential is going to be less. You want to have that safe nest, pay off your primary residence. But as far as investment properties, get as many loans on it on that as you can. So there is also an option of IO, interest only. That's a very typical option for short-term loans, hard money loans. And there's also some longer term, some banks offer longer term products for 10 years. You only pay interest. What does it mean? It means you're getting $1 million mortgage today for 10 years. You only pay in interest. You're not amortizing, and you're left with $1 million mortgage 10 years from now. Why is it beneficial? At least for the investment properties, you're getting more money in your pocket every month for the next 10 years that you can invest. You can go on vacations, I don't know, do crazy things, or invest for your kids' college. Let's say you're on a budget and your payment is $5,000 fully amortized over 30 years and $4,000 interest only. Pick interest only, you have extra $1,000, you can feed that $1,000 a month into retirement account, kids college fund, just another investment account, steadily at $1,000 a month. That's 12 grand a year. That's 120,000 over 10 years, for example, plus that rate of return you're going to get from your investments. Okay, S&P 500, whatever it is. Okay, so longer term gives you more flexibility today. You're not paying off your house as fast as you may want to, but you having less payments every month, and those payments can be adjusted. Also, when you have a 40-year or a 30-year loan, you can pay more. You can always pay more and shrink your amortization period and actually do pay off house in 15 years. You're just going to have to pay extra so many dollars a month or once a year, twice a year, whatever it is. Okay, there's options if you're going to be financing with some smart people out there. They can print out amortization schedules for you. They can properly advise you, but don't jump on the first product that you want. And also, don't think you want to pay off your house as soon as possible, especially if you're not sure, you're 25-year-old kid with high-paying job out of college, you're not even married yet, you're not going to pay off that house, okay? You're going to have 17 more houses after that. Thank you, guys. Please subscribe and let me know what you want me to talk about next time. Thank you.